Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really happy to have you join us. We are trying to help you improve your retirement, especially financially. We do that by answering your questions. You can send those in now if you want us to answer them live. Two different ways. Got an email address here, asktom@talkmoneywithtom.com. You can send that. We'll see it right now, try to answer. Or you can just put it in the chat function here on the YouTube channel if you're signed in. So obviously the channel's here for your use. We've got thousands of videos on here, all kinds of different subjects, retirement planning, asset management, tax planning, those types of things. You can subscribe to the channel, hit the bell button if you want to learn when new stuff comes out. And then, of course, if you just want to meet with Ethan and I, we can do that also. We don't charge anything for a 30-minute appointment just to answer your questions. You can actually set that up yourself. You can go to our website. There's a link for that here on the channel. Up in the corner is a button, looks just like that. And you can set up a 30-minute time to meet with us, in the office, whether you're client, not client, whoever it is, we'd be happy to help. That's what we're trying to do. We get up on Fridays and come in here and get ready for this show. Just trying to help, actually, as far as that goes. And so we find that fun. So, okay, so a big part of retirement, of course, will be the ability to make enough money with the money that you have to live off of, keep up with inflation, and then obviously to not lose enough of it to affect dramatically to the downside your retirement. Now this is true, whether you're accumulating for retirement now, and the strategies you might have, or you're in retirement and those types of things. So I always like to start off the show with a summary of kind of what we saw happening in the stock market this week. And my objective is to try to educate everybody on how the stock market is working, what it's looking at. I've found that the more people understand about the market and the lingo and the different things that are happening, the more comfortable they are, usually the better investor, even if they're working with somebody like us, as far as that goes. So let's start off with our chart that we use. And so, this is going back to 2018. We can see the ups and downs that have happened. And actually November so far has been a down month. I think we hit our peak right on, Halloween. And so, what's the difference? Why is the market all of a sudden having softness versus really pretty strong? This week we ended up completing a 5% down, which we haven't had in over 100 days of trading. And so, 5% is a nothing. They happen on a regular basis. 10% happens once a year on average, going back long term.
3 times per year is the average.
3 times for 5%?
Yeah, since 1950.
That sounds very likely. So, every downturn starts with a 5% downturn. That's the problem. So every 50% downturn, or whatever number you want to pick that would scare you, starts with the 5% downturn. But not every 5% downturn turns into a 50% downturn. And so, matter of fact, most don't. We do get a 20+% downturn, I think, roughly every 5 years on average. So, and certainly have had, our share of those here just in this chart. There are a couple of them here that look like 20% downturns, but they're like 19%. And then, of course, the pandemic and 2022 was down 28%. So, so you have to be careful with, kind of worrying too much because we don't have any change of direction here. Technically, if we look at the chart there, on a weekly basis, we have not hit a new low, a lower low. And on a daily basis, we kind of matched one, got really close, but we're holding up inside of that. So, all the things we look at on a checklist for primary direction are up. I won't list them all, it gets kind of boring, but nonetheless, none of that has changed. And so at this point in time, you're looking at this as really, you have to look at these as kind of buying opportunities, or if nothing else, just a chance for the market to decompress, right, from that stretch. It's like I've always said, it's a rubber band. You stretch it more and more and more and more, it's going to snap back farther the farther you stretch that rubber band. And so, when you have high rates of return and really big movements to the upside, you basically just expose yourself to bigger moves to the downside, at least in the short term. And so I do like when it lets off some of that pressure, because eventually you pull that rubber band far enough, you could really that's how you get the bigger downturns.
Yeah, you get the snap rather than the rebound down.
Yeah, and it can really, the fear sets in. So what happens is, something is a catalyst to kind of stop the momentum. Sometimes it's just the fact that it has already ran so much. And it's funny to me that here's something I find very humorous. The press all week long and last week as the market's coming down is, the market is worried about the valuations being so high on the AI bubble. I guarantee you the market's not worried about valuations in this particular type of market. That is not why it's coming down. Maybe there are some people taking profits, rightfully so. And we saw some really big players making big moves on companies like NVIDIA, like SoftBank selling their, $5.8 billion, holding. Now, NVIDIA is doing great. They announced their earnings on Wednesday after hours. Fantastic earnings, over 60% growth on both revenues and earnings. And the talk from the CFO and the CEO, I thought was very positive to the point where, they were saying, hey, we have unlimited demand for this. It's a Blackwell, I believe the chip is.
Yeah.
For the Blackwell chip. And, those are good things. If you're worried about the AI trade, or, slowing down or whatever it is, NVIDIA is a good place to take a look. And so that's why it's such a heavily followed, report. Comes late in the earnings season. So the market was up yesterday, 1.9%, and then ended up, so it was a green shirt day in the morning. And by the time the market closed, it was a red shirt day. It was down a little bit over 1.5%. And so what's important to remember is that this week is options expiration day, is today, okay? It's third Friday of every month. And what happens is normally the Friday of options expiration day can be quite volatile, and you have to be careful of not attaching too much emphasis on it because it's just they're unwinding these options, closing them out. There was $3.1 trillion worth of options coming due today. So what we have seen, though, is we're starting to see the day before, the Thursday. And this is a pattern. If you watch, so if I'm going to unload my options and I know that Friday is going to be volatile and I don't want to deal with it, maybe I'll do it on Thursday, right? So everybody's starting to do it on Thursday, and we're starting to see more volatility on the day before. This happens all the time. We used to have a thing called the January effect because January was a really good run, especially the beginning of the year. And then that became the Santa Claus rally because people started to get in early. And now, if you take a look, November has been one of the biggest months of the year. We're not having that this November. Part of that is because we had such good rates of return. October is an average month. September is a bad month on long term, going back to 1928. We had good returns on both of those months. That's probably not because people are shifting forward as much as it was because we had 2 interest rate cuts.
Yeah, and the market really likes their rate cuts.
They really do. 8 out of 10 times the market's up. I think the average is 12%, 12 months later, right? Well, we covered that in the show some time back. Now, the 2 out of 10s where it's not as up is the kind of the problem because that's when the recession actually came and they were lowering rates before the recession. Oftentimes they're lowering rates. It keeps us away from recession, and so that's why 8 out of 10 times you'll see the market, move. It's actually very unusual to lower the interest rates when the market is near an all-time high. So when that happens, generally speaking, the returns are even better historically. We'll see. Historically, we didn't have tariffs, so you have to be really careful analyzing the data going back over the long term because it doesn't include tariffs. It's kind of like when during the pandemic, you take a look back at the data, it didn't have any pandemic time frame in there to really compare to. So it's a little bit what's happening here. So we'll have to wait and see how that goes. But nonetheless, we have to be careful. And so when there's an option expiration day, I've seen sometimes Friday can also be down or volatile or what have you. But Thursday is starting to become much more so. Really, you want to look at Monday. If you don't get that rally on Friday, we're getting a rally today. It was up, 1.4% last time I looked. So I think we're fine. We're still going. People are worried about the valuations of AI. We're not at that point yet. Eventually, when the market falls apart, valuations become extremely important, especially in the bottoming and recovery of a market downturn. Everybody's looking for things that have safety and higher value, better earning streams, cash flow, less debt, quality, right? Becomes the issue. Right now, quality is not the issue per se. We are seeing some rotation this month into some of those things, but we've seen that several times in this recovery, and it hasn't lasted. Sort of like the small cap stuff, right? Tends to run, doesn't last. It's kind of amazing. Someday, some of these things will take off and really start to go. But nonetheless, It's been really interesting. Now let's talk about why. All right, so the number one reason why, in my opinion, the market has started to come down is it just takes a little catalyst, and then everybody looks around and says, "Wow, we've made a lot of profit. Let's start taking some of that profit off the table." And so I think the biggest catalyst is the Federal Reserve, and so there's a lot of data on here. We showed this chart last week, and really what happened was the rate cut expectation for the market for December. At the highest point, it was 99.4% chance that we would have a 1/4 point rate cut. All right. Last week was closer to the lowest point where it hit a 40% chance. So that's a huge differential. So the market's already running up in anticipation of another rate cut. And then Powell comes out, Chairman Powell of the Federal Reserve, comes out and says, hey, right after the October meeting, December is not guaranteed as a rate cut. I mean, more or less, actually directly, but he added to that too. And then we had a series of different Fed governors coming out over the last few weeks talking about the inflationary impact and, saying, hey, what are we going to do in terms of may not lower rates? And then we got a jobs report that was kind of mixed, right? And it was old too, because we got jobs report yesterday for September, because the government was closed, and there was 119,000 jobs created, and of course we have to take that with a giant teaspoon of salt, because what happens there is, first of all, they keep revising these under all administrations so dramatically that I don't know what it's going to be. 119,000 doesn't mean anything to me anymore. And when we got a bad number in July, we fired the person that was in charge of the BLS who does these numbers. So now you got to wonder, of course, if we're getting good numbers anyway, one way or another. But the unemployment went from 4.3% to 4.4%, which is the highest it's been in 4 years. So, and then today, actually, the consumer sentiment survey that came out of Michigan is almost at a record low. People's expectations for costs going up, their possibility of losing their job. The consumer right now, at least answering in a survey manner, is not happy, right?
Yeah, they're very negative.
Yeah, well, sometimes that doesn't translate to dollars spent, It's one thing to answer a survey, it's another thing, to deal with it on a directly dollar spent level. So we'll watch for that. But what we did see today is a big jump. And so that's now at 73.5% chance of a rate cut. So that's just today. It basically went from 40% to 70+% because we had one of the Fed governors coming out and saying, hey, could see a way to lower rates. December 10th is the meeting, and so that week we'll hear about whether they do a rate cut. So, and the market's up today based on that. So you can kind of see where the driving force is coming from on this. And again, whether they cut rates or not, I don't know. Whether they should cut rates or not, I do think they have room to cut rates here another time. Again, I'm not even sure that rate cuts are going to matter that much as the market seems to think, just because of the structure of how this has happened. They're trying to support a labor market that is getting hit by things that rate cuts. We talked about this last time, but between the cost of tariffs and the cost of AI build out, we're seeing what we saw 153,000 layoff in October, right? Very high, a 22-year high for a monthly basis. And, cutting rates to me isn't going to change those two things. You still have the tariffs to pay for, and you're still trying to invest in these AI build-out pieces, right? And those are, in my opinion, those are the two main reasons. And the third reason would be the fact that AI is creating higher productivity for those employees that are still there, and maybe they don't need as many. Because a lot of these layoffs have come out off of these companies that have this AI exposure, the Amazons and whatever in the world.
The whole thing of changing automation, manufacturers have been dealing with this for years.
Yeah.
We're still maintaining the same production level as we've been for decades, but with fewer and fewer employees.
Yeah, exactly. And so the productivity per employee is going up, which makes sense. I mean, the internet, the computers, the AI, eventually robotics will help even more so in the manufacturing area, and et cetera. And so that's what kind of started it. And of course, the valuations are kind of high. People have good profits. September and October were up. And those things that we saw go up a lot, like, Bitcoin type, cryptocurrency, the different types of, future computing components that are out there are all have taken a hit, this month as far as that goes. All had huge run-ups in November. Mm-hmm. Now, the other thing that is striking me is really just what's happening in the cryptocurrency market, and I think there might be some relationship there. So here's a chart going back, just to show the April lows that came there at the beginning of the chart. So the green portion of the chart is the S&P 500 itself, just like we looked at before. This is on a percentage basis now. And the blue overlay is the iShares Bitcoin ETF. IBIT is the ticker symbol. And if you look, that Bitcoin, that ETF topped out about 3 weeks before the market did. And then has fallen, a fair amount thereafter. And so the thing, one of my clients last week, I think it was, asked me, I don't have cryptocurrency in my accounts. I understand that. But will cryptocurrency, if it falls apart, affect my accounts? Mm-hmm. Really good question. And the reason they're asking that question is because in 2008, we all started to hear about subprime mortgages. Yeah, so they've lent money to people that couldn't pay it back. These were low quality mortgages. And, we're starting at the beginning, you're starting to see all kinds of banking institutions and different stocks that had exposure to that, coming down. And you look at your portfolio and you're like, okay, we didn't have any exposure directly to, low performing mortgages. And so in the end, when all of that fell apart and those mortgages started to default, we found out that there was a credit default swap, which was basically an insurance policy on that mortgage, which had to pay off. And they had to sell everything you owned in your portfolio to pay that off. And so we ended up with this giant drop. And then, of course, Lehman Brothers failed, and we ended up with a 30% additional drop, and we fell 57% because of subprime mortgages that weren't in our portfolio. Mm-hmm. Does that make sense? And so the answer that I said to this client is definitely it could have an impact. Oftentimes it's hard to see the linkage. Sometimes it's easy, but you don't really see the ultimate linkages, especially in these markets that are a bit more private. They're not out there like private credit. We don't know how much in private credit's out there. We don't know the quality of private credit. Jamie Dimon's been running around, the CEO of JP Morgan Chase, talking about a small downturn in the economy could turn into a much bigger downturn because of the low quality private credit that's out there that's going to start to default. And of course, those companies are going to need to cover some of those defaults with capital, and sometimes they'll go into their other areas of assets like stocks and bonds to cover that drop. And so when you see Bitcoin falling, and then you see the market then fall thereafter, it could just be that it's a precursor, but it also could be linked. And so that's the thing that worries me. So if I'm buying cryptocurrencies and I'm using much leverage, and so you can margin cryptocurrencies 100 to 1. So you put up $1 and buy $100 worth of cryptocurrency, that type of thing. Of course, it doesn't take much to wipe out that dollar or to even get a margin call. So if you're getting margin calls, that means that you've got to come up with cash. You either have to sell the position at a loss to cover the margin, or you have to come up with additional cash to place in that if you still want to keep that trade. And so maybe somebody's selling some of their stock market assets, for example, to cover those margin calls. We'll see. So I do think it's important, though, to follow what's happening with cryptocurrencies. And this particular chart, there's lots of currencies out there, but this is the Bitcoin, which is we'll use it as a proxy here. It's not the best thing ever. But if we take a look, there's something interesting that's happened here with this particular ETF. There's a thing called a head and shoulders pattern, and I got this off of the internet. The red line there says neckline, right? So there's a period where there's two shoulders. You see the three little circles, two different shoulders, and the head. The neckline is often sloped downward, just like it shows here. The second shoulder is often weaker than the first shoulder, just like it shows here. The head has to be higher than both shoulders, okay? And then if you break that neckline, what it says there, kaboom, prices drop. Well, look at this. So here's Bitcoin, right? Pretty classic head and shoulder pattern there. Sloping neckline to the downside. One shoulder's weaker than the other. The head is higher, right? And when it broke the neckline, kaboom, the prices really fell for a total of about a 35% drop from high, right?
Yeah.
So if you've got some margin on there, that could be a problem. So I do think, paying attention to what's happening to an ETF like this might, if it is linked and there is some, issues with that, then we might want to be watching Bitcoin's price movement to see where it might find a bottom. Yeah. And so I drew in this kind of blue line just above my head as a possible support point. It's already kind of in the support area. If you look back there, you can see where it's consolidated for a bit on the way down. That support, we've blown through the other support, was right around where that neckline was, so boom, there's no real support in there for where it is now. So, today up a little, I believe, IBIT possibly, because everything else is going up. It seems to be responding to, the rate cuts also. And so, the problem with Bitcoin or any of the cryptocurrencies is technically there's nothing behind it other than new people coming in with new money, which is happening. It's a worldwide phenomena. You basically are looking at a lot of these technical indicators because we're not looking at earnings or, those types of things. With Bitcoin, doesn't have anything. Matter of fact, it still doesn't really have a use case other than just as an investment, that you hope goes up. So it's going to be volatile. There's nothing wrong with that. It's just, does it get linked to the stock market as more and more governments and corporations start to get involved with cryptocurrencies, stable coin, right, which is different, but still has the ability to create uncertainty and instability at some point in the future, in my opinion. So that's what's kind of different about what's happening right now. So it kind of starts off with this, situation where they're lowering rates, and then they're not going to lower rates, even though the market thought they're going to lower rates, and now they think maybe they will lower rates, and we're going back and forth. And if you look at the minutes from the last meeting, you can see that the Board of Governors for the Federal Reserve is more diversified in their opinions to what to do for rates than I've ever seen. And it's pretty extreme. So usually it's pretty comprehensive together. Even if there's some people that disagree, they try to all vote together. That isn't happening right now, and I don't think that's going to happen in December as far as that goes either. So, we've got a ways to go to December to see what, might actually transpire. But anyway, that's what's going on. Got, rate cut, concerns, whether it's happening or not, kind of starts the catalyst to the downside. It's already high enough. It needs a catalyst to the downside anyway. 5% down is okay. A consolidation period at this point could turn into something worse, but you can't assume that. It's less likely to turn into something worse on just a pure odds basis, right? For 3 times a year, the market drops 5% on average, but it only drops more than 20 every 5 years. So every 5 years, you got 15 5% downturns, give or take, and one of them turns into a 20 plus. That means 14 out of 1. So market investing is a probability game, and you got a 14 out of 1 chance that this 5% downturn is not the next 20% downturn. And so it becomes a buy opportunity or just a chance to let the market go sideways more or less and take some of that pressure off. So I don't see any problem with this at this point in time. Things can change, things continue to deteriorate, we get some new lower lows, we start to break through 50-day moving average, those types of things. There are some pieces that can start to give you some more concern, but we're not really there yet at this point in time. This is a normal activity for the stock market. This is how it works. There's lots of reasons why. I think it's important to kind of understand. And I don't think that the fact that they're raising rates or lowering rates in December is going to be that big of a deal in the end. I don't think it's going to matter. It matters now because it's already factored in, but I think we're already squished most of that out with this downturn. Anyway, so that's what's happening this week. We won't be here actually next week, and I won't be doing it's Friday, Black Friday, after Thanksgiving. I won't be doing a summary either, but we'll get back to this summary again in 2 weeks. So look forward to covering it again then. All right, let's cover our first questions.
Should we be worried about the large bond issuance to fund AI build out by the major tech companies like Meta, Google, Amazon, Oracle? They're issuing bonds at an unprecedented rate for themselves.
Yes. We actually have a chart. It's a really good question. And so this bond issuing by ATI. So yeah, Amazon, Alphabet, Meta, Microsoft, and Oracle in this particular case. And so you look back, in terms of how much they've issued in bonds versus what they've done in 2025. You need to understand how they're funding, this very expensive build out, right? And one of the problems is if you're a public company, the expectations are during normal markets, which is kind of what we have now, that your earnings will continue to meet those expectations or beat those expectations. So how do you do that when you're trying to spend $100 billion on AI, infrastructure? Well, one of the things you do is you cut your costs. And so we've seen from these companies specifically some layoffs that have been happening, right?
Yeah.
And so, that way I can spend some of that money I was spending on people on this AI build out and not impact my earnings.
Yeah, you keep your expenses the same,
Right.
while just cutting in elsewhere.
So one of the other options is, you could go out to the public market and sell shares. That doesn't happen with these companies, because
They don't want to dilute it.
they don't want to dilute their share price. Now, if you're a private company and an IPO, and I think we're going to eventually see this. So right now, all the kind of pure AI companies are private, OpenAI being the biggest example. But and reason being because there's so much money flooding around either from borrowing or from investors to come in on a private basis, they haven't had to go IPO. That's a little bit different than what we saw in the dot-com bubble because the IPO market was super hot. And it was where people went to get money to develop their company farther. It's what keeps companies like Amazon, going. But so they've laid people off. They don't want to issue new stock. So the next thing to do is to borrow money, right? Because if I borrow money, I don't have to put that in my earnings report per se. What happens is I have to put the interest that I pay will knock off, but that's a lot less. So this is a little over $100 billion so far borrowed from these companies. All right, so the interest on that is less impact to my earnings today or next quarter than they would be obviously the whole if I paid for it out of pocket because I would have to potentially account for that. Although what they are doing is they're depreciating it, which we'll talk about in a minute. Okay, a couple things just to answer the questions. Does it bother me? Not really. Honestly, $100 billion for those type of companies as a combination. I mean, their market capitalization is ridiculously high.
Yeah.
Their cash positions are high.
Yeah, Google right now has about $98 billion in cash.
Yeah, and their debt to equity ratios on these companies are ridiculous. One of the advantages to them is they can go out in the market and get really low rates of return that they have to pay on those bonds.
Yeah, because they just don't have that much leverage on them.
Right. Yeah, they're a good bet, right? Matter of fact, you can make an argument they're a better bet than the U.S. government to a certain degree, which is seen as the safe bet for these treasuries and what have you. And so, not too awfully concerned. Obviously, in the end, you don't want to be saddled with all this debt if it's not going to work.
Yeah.
And that's the risk. And right now the market is looking at that and saying, hey, we're spending money, but we're not getting any money back of any substance. And so when are we going to get money back? Because that's going to matter. If we just spend, and still have to pay this debt back at some point in time, we're eventually going to have a hit to earnings. And obviously not every company is going to make it work. I mean, AI might work in total, but Amazon came out of thousands of companies that were trying to make it work, right? So that's kind of how it works. And matter of fact, you go back to Detroit in the 1920s, they had 2,000 car manufacturers because that was the dot-com bubble at the time. Was just everybody's trying to make a car, and 3 major companies came out of that. And the same thing with the dot-com bubble. The same thing will happen with AI. Some companies, probably just a handful, will end up being here. And what you're having right now is a billionaire race to try to become trillionaires. Because whoever can make this work and really get their data centers more organized and more efficient and their algorithms working and who has the data, Alphabet jumps out as as a good option here.
Yeah, they have a lot of excess revenue from other sources,
Yep.
and just the quality of their data. They have so much data.
Because that's Amazon's got a lot of data, a lot of purchasing data. Meta has a lot of data, all the little things that you're posting and what have you, and Instagram is part of that. Alphabet, has the Chrome. Every time you're searching in Chrome, they're now searching through your Gmail,
Yeah.
and they're also looking at all the stuff on YouTube. Right? So they got a huge amount of data as far as that. Anyway, so we'll see how that works out. But one of the things that does happen that's been interesting is they're now changing the depreciation on the useful life for these components. So if I spend $100 billion, I don't have to count it against my earnings other than the interest and the depreciation, right? For that. And so if you look, what they're doing is they're stretching out the useful life. Like if you look at Google there, that 2020 it was 3 year, right?
Mm-hmm.
Right off. Now it's 6. They doubled it. And what that does, it just it has less impact to the earnings.
Yeah, you lower your depreciation expense per year, essentially.
Yeah, what's 3 year depreciation on 100 billion is 33 billion a year. 6 year, so I have to take that off my earnings, 33 billion. 6 year, I cut that in half, and so I have whatever that is, 16.5 billion to take off my earnings. So that's what this is about. This is about public companies still trying to produce earnings growth in an environment where they're having to spend way more money than they normally would on these projects. And it is a race to see who can kind of get there and make it work. I think it's going to be a really fascinating race. And if you listen to the wording from what came out of the conference call from NVIDIA, I don't know, it's pretty exciting. I mean, obviously they've got a vested interest in saying exciting things because they're selling a product. But, at the same time, they're flat out cannot keep up with the demand, which really tells you something, that there's still a lot of interest within these companies to do that. So it's a really good question. I think it's, a little bit on the sophisticated side, but I don't have a problem with the borrowing. I think as a percentage of total, it's fine. I think it's a good way to do what they're trying to do without knocking down earnings. Eventually we're going to have to see AI work. And
Yeah, I don't think it's going to make a difference if, AI becomes profitable,
right,
and one of these companies succeed. Their bond issuance will be a non-issue.
I tend to have a bias that these companies are something we know about and run by people that are smart enough. If they think AI is really fantastic, I got to pay attention. They know more about it than I will know about it. And if they're willing to spend that kind of money and really, and they're really going for it, right? I mean, even laying people off and all these things to try to race to this. I gotta feel that there's something there somewhere that'll come out of this. Just because in the past, we very rarely had something completely go bust, concept-wise. In the internet, there was lots of pieces that went bust and lots of companies that went bust. But the overall concept was unbelievable. Here we are. 1995, we wouldn't have been able to do this. I guarantee it. Can't do this on an AOL dial-up, DSL connection, which is what we had, which we thought was, unbelievable at the time, to be honest. So anyway, it's a good question. What's our next one?
Can you compare this pullback to previous ones? Where is it, like, this pullback in the grand scheme of things? Because it feels like it's a lot more volatile. The market's moving much more extreme directions, either way up or down, versus, kind of the previous ones we've experienced.
Yeah. I think back to, to me, the dot-com run-up was somewhat similar to this. And we did have, if you compare those side by side, we had our fair share of 5% plus pullbacks, that happened. So I don't see it that different. It just personally, what happens, the volatility comes because of the stretch. Valuations aren't critical, but there's enough people that pay attention that you get some selling at different points in time. When you look at the forward earnings projection and the PE ratio for that, we're at nearly an all-time high. When you look backwards, like with a Shiller PE ratio, which is a 10-year average income from the past, factoring out inflation, we're at the second highest, point that thing has been in since 1880. So you're going to have a bit more volatility when you stretch the rubber band. I mean, it's a great analogy because we're up here, the pressure to come down gets higher the more we stretch. And so, we get that little release of some of that pressure. So that's pretty common. I would say that the thing that's different and the thing that could cause even more volatility, first of all, markets have gotten more volatile over time. It's just too easy to move money. But just in terms of this particular downturn, the headwinds that this market is running into are pretty unprecedented. If it wasn't for AI build out and the projected $4 trillion that's going to be spent over the next 5 years by those companies we were just talking about, this market would probably not be doing well at all, and so because the headwinds of, tariffs and deportations and closing down the government and, all the threatening the independence of the Fed, and even the fact that they're going to replace the Fed governor in May, I'll bet you anything that's going to be a pretty big event. The market probably has a lot more volatility around that time as we get closer and closer to that, because there's some real concerns that if you somehow try to reduce rates by some drastic amount like they want to, that it could create some huge problems. And that's why they try to keep the Fed independent of political decisions. The Fed shouldn't care about what happens in the midterms. And that's why they try to keep it independent, because obviously the party in control cares about what happens in the midterms. Yep. And so you could end up with these people, if they're running on a political basis, lowering rates when they shouldn't be and creating, massive inflation. And so those are the things that I think are different here. And they've been different ever since, January 20th. And it's just this pile-on of pieces. Now, there's a whole bunch of parts that are helping besides AI. And so that's, the fact that they're lowering rates, at least so far. The fact that we have some lowered regulations that I think will help eventually. We got this big, beautiful bill, which we'll see how that goes. It seems to be bothering the bond market a little bit because of the projected deficit. But at least from the stock market standpoint, has some visibility on tax rates for a while, which matters. Because if you're going to, the more confidence you have about the future, the more you're willing to invest as a CEO of a company. I think, unfortunately, that's being offset by all of the chaos being caused by the world trade market being thrown up into chaos with the tariffs and the changes in the tariffs. And every time they change things, they have to go back. And I'm reading article after article where, these companies are spending a significant amount of resources, time, money, and people to try to deal with the tariffs and try to figure out what they can do. How can they find a better way to get their products? What do they have to pay? What's the paperwork? And I have CEOs that were like, yeah, last year we weren't talking about this ever. Now we're talking about it at every meeting. And so that does make it a little bit of a situation that there's some headwind. That's a headwind. Capital expenditures go down because companies don't have this feeling of confidence. So I think that's out there. However, the AI trade and the enthusiasm around that, and the fact that most of these indexes are really kind of dominated by these big companies that happen to be involved in this AI trade for the most part, is enough to drive this. It's the teeter-totter is still to the upside. We have to watch for that, right? And there could be other headwinds. Maybe Bitcoin's connected more to the stock market than we'd like to know, and if Bitcoin falls apart, stock market could follow. Those type of things. But I think that's what's a little bit different here. It's just those headwinds, they weren't there. The last time we had a market like this, in my opinion, was that 95 to 2000. And we've talked about that before. We could still be having that same run, very, very much so. The end of it was huge. I mean, the NASDAQ doubled in 1998. But maybe we don't get that much run up and that much blow off because the headwinds that are here now that weren't there in that 2000 downturn. And so I think that's kind of what's different as far as that goes. So anyway, it's a good question. I think it's very interesting. I wouldn't worry that much about this particular downturn at this point in time, just because of the way things work. Okay.
What should I do with extra 529 funds? My daughter, I started saving when she was born, but in the end, I have extra $100,000 and she's done with her education. What are kind of the options that I have available to me?
Yeah, let's just start with a little bit of advice for those people that don't have, that yet. And we've been talking about that for a while, and just that you probably don't want to put everything you have into a 529 plan to save for college just because you don't know. I mean, you should start early, but you're looking at a 2-year-old, and who knows?
Yeah, you don't know where your child is going to be.
And so that's why we advocate kind of splitting those dollars into 529 plan, which grows tax-free as you withdraw it for college savings. Really good program. In some states, you can even get a write-off for putting money in there. Definitely maximize that. However, if you have more money that you want to put aside, put it into an account. Maybe you just open up an account. It's in your name, your spouse's name, whatever. It could be in a trust. Doesn't matter. It's just not in a 529. And mentally, you designated that for college. But now it's not stuck in a 529 if they don't go to college.
Yeah, they may have unrelated expenses to college that you could pay for with that money.
Yeah.
That don't qualify.
Yeah, maybe they want to start a business or buy a house, or maybe you use it for yourself for whatever purposes for that money that's not in the 529. But getting back to the question, what happens if you have too much money in the 529 plan? What are your options? You know, even if your kid went to school, maybe it just wasn't that much.
Yeah.
Right? And, you know, and we've seen that quite a bit. There's quite a few lingering 529 plans within our practice where, you know, people put in more money and they grew too. You know,
Yeah.
we helped that. Anyway, so one thing is that the nice about the 529, the change of beneficiary, so to speak, is quite simple. And so if I have a 529 with one of my children and that child doesn't need it, I can change it to one of my other children.
Yeah.
Right? So maybe one child doesn't go to college or doesn't cost that much, and my other child is going to a very expensive school. I can change the beneficiary of that. Now I can keep that going forever. So this could be kind of a legacy thing. So
Yeah, you can make kind of like a generational 529.
yeah, so I can now, you know, once my kids had used what they need, my grandkids come along, I've still got money in the 529. You know, you can keep it rolling as far as that goes. And so you could use it on yourself if you decided to go back to school for something. You could,
Yep.
you could. So that part of it's really cool with the 529. That's a really interesting piece. But there is a new rule now with the Roth IRA where you can put some money. So explain how that works.
Yeah, so with the Roth IRA, as long as you meet the restrictions, I think you have to have that account open for 10 years. You can, and as long as the beneficiary has earnings, you could say, hey, we're taking some of the 529 funds and we're putting it into a Roth account for that beneficiary. So you would have up to kind of the annual maximum each year, but you can do a total of $35,000. So I think this year is $7,000 for 2025, and then 2026 is $7,500. So you can, over a 5-year period, you probably remove a lot of money and move into a Roth for them, which is kind of setting up their retirement on it, like just supercharging it early on.
So I have to have the 529 for at least 10 years. So if I don't, I have to wait, right?
Yeah.
So I get to the 10-year period, and I've got a son or a daughter listed as my beneficiary, and I don't have anybody else that I want to switch it to. I just want to try to figure out the best way to do it. And so that son or daughter gets a job, starts making at least $7,000, let's say in this case. I can take $7,000 out of the 529 and put it into a Roth IRA for them up to $35,000.
I missed it. It's 15 years now, not 10 years.
Oh, 15 years of
Yeah.
keeping it? Oof.
Yeah. That's been
Okay.
open and maintained for 15 years.
And we have some that have been around that long. You got to start early, but chances are you're probably going to have to sit on that for a while for most people.
Yeah.
As a lot of people don't start, because you would have had to start that at like 3 years
Yeah.
old or what have you. If you're dealing with an 18-year-old that's not going to college or not going to cost as much. And so, but that's a really good option, right? I mean, you get $35,000 over, say, a 4 or 5 year period that you can place into your young, daughter or son's name, and it grows tax free for the rest of their life, and they're in their early 20s or what have you when that happens.
They got the compounding of interest.
Yeah.
Over time, they have one of the strongest things you can have in the investing world.
Yeah, so I mean, if you're short of that 15 years, you just look at it like any other investment. I'm just going to grow it as much as I can. I'm going to manage it within the platform and see what options are available and try to get some growth out of it. And then, at the end of that period, I can start to move $7,000 a year or whatever it is at the time to a Roth IRA for that child. So I think that's there's some good options on 529s. Try not to overfund it, but it's almost impossible. I mean, if somebody doesn't go to college, any money in there is overfunding
Yeah.
it, right? I mean, theoretically.
Yeah, and
it does pay for other types of schooling, though. It's got
they're,
some.
they're trying to make it a little bit more expensive,
Right.
adding trade schools, apprenticeships, and other kind
Right.
of things. So they're trying to make it so it works for you. And worst case scenario is you can take the money out.
Yes.
You pay taxes on the earnings and a 10% penalty, but you'd still, if it's grown over that time period, you still earn something on it.
Yeah, so if you got 100,000 in there, and let's say it grew 10,000, you put in 90 just to make up some numbers, you'd pay taxes on that 10,000 of growth,
And
ordinary income taxes, and then a 10% penalty. Is the penalty just on the growth or on the whole principal and growth too? I can't remember. I would be a
I'm
little
pretty
surprised
sure-
if it's on the principal because the
Yeah, I'm pretty sure
principal's
it's
already been taxed
it's usually on
on the growth.
the growth.
So that would be another, in that case, $1,000 penalty if it was 10,000 plus the taxes on that 10.
Yeah, it's only on the growth.
Only on the growth. Okay, that which makes sense. Generally, they try not to double tax money or penalize money, and so that 90,000 was after tax money that went in that particular case. So yeah, it's a good example of options. Withdraw it, keep it long enough to do some conversions to Roth.
Pass it along.
Pass it along to somebody else within the family. Keep it for generational 529.
Yeah.
I'd probably keep it personally just because tax-free growth. I hate taking tax-free growth out. I would do the Roth thing because that's also tax-free growth.
Yeah.
You're just putting it in that even longer potential bucket actually of tax-free growth. So I always try to keep tax-free growth and tax-free growth. And once you get it there, just try to keep
It's
it
hard
there.
it's hard to get into tax.
Yes, it is. Not impossible, but it costs you. Okay, good. So that is our show for today. I want to thank everybody for coming. Some great questions today. We spent some good time on some of them. Hopefully that helped. But send in your questions. Again, we'll be back here in a couple of weeks. So if you give us some time to work on them and come up with some charts or whatever we might be able to do and give you a good answer on them. You can send them to asktom@talkmoneywithtom.com. Of course, we feel very much so that the educational level in these areas of retirement planning and asset management and tax planning are really kind of lacking. And so that's why we have the channel. So you can subscribe to that, hit the bell button if you want to get notified when we put new stuff out. And then obviously if you just want to meet with Eason and I, you can do that too. Client, non-client, 30 minutes, doesn't cost anything. Buttons up on the corner of our webpage, and pick a time in office, phone, video, whatever works for you. So anyway, looking forward to seeing you again in a couple weeks, and everybody have a really great Thanksgiving. I will put out the daily video on Monday and Tuesday, and that'll be it for next week. So look forward to seeing you then. Thank you very much.